The Global Robotics and Automation Index ETF, better known by its ticker symbol ROBO, is one of the most well-known thematic ETFs focused on the growth of automation, robotics, and artificial intelligence technologies around the world. This fund was launched in the year 2013 and is managed by exchange-traded concepts, tracking the performance of the Global Robotics and Automation Index. Its goal is simple: to give investors exposure to companies across the globe that are actively involved in the entire robotics and automation value chain, including artificial intelligence, sensors, machine learning, and advanced manufacturing. Let's break it all down in plain English. Robo does not concentrate all of its capital into just a few mega-cap tech names like some other technology ETFs. Instead, it offers a more diversified exposure to around 80 to 90 companies that are categorized into two major segments: enabling technologies and applications. Enabling technologies are companies that provide the foundational tools, such as sensors, semiconductors, and processing power. Applications include companies that are building the actual robotic systems and automation services in sectors such as healthcare, industrial manufacturing, and logistics. Unlike passive ETFs like VOO or SPYG that track broad indexes, Robo is actively curated using a scoring system developed by Robo Global to select only those companies with meaningful exposure to automation and robotics. These companies must meet strict criteria for revenue exposure, technology relevance, and global reach. This creates a portfolio with a balanced blend of large, mid, and small-cap firms from North America, Europe, and Asia. Let's look at performance and risk. Over the past 5 years, Robo has delivered a mixed performance. During the bull market of 2020 and 2021, it saw significant growth, driven by investor excitement over robotics and AI. However, like many thematic ETFs, it also experienced a major pullback in 2022 due to rising interest rates, lower earnings expectations, and tightening financial conditions. As of today, Robo has a net expense ratio of 0.95%, which is relatively high compared to more traditional ETFs. This higher fee is justified by its specialized exposure and the active index methodology used to maintain relevance in a fast-moving sector. Robo does pay a small dividend, but it is not designed as an income fund. Its yield is typically below 1% annually, which means most investors are in it for growth rather than cash flow. In terms of volatility, Robo can swing more dramatically than broader indexes. Because it includes small cap and international firms, it is more susceptible to currency risks, regional economic shocks, and liquidity issues. But for long-term investors betting on the global rise of robotics, this volatility may be a feature, not a bug. Now let's talk about diversification. Robo spreads its holdings across sectors and countries, giving investors exposure to not just the United States, but also Japan, Germany, Switzerland, and South Korea. This global approach means Robo can capture trends happening in international manufacturing and logistics that may not be present in US-only funds. Some of Robo's top holdings include companies like Intuitive Surgical, which develops robotic surgical systems, Keyence, a Japanese firm specializing in factory automation sensors, and Harmonic Drive Systems, which creates advanced gearing solutions used in robotic arms. None of these companies make up more than 2% of the portfolio, which keeps Robo from being top-heavy and overly dependent on just a few names. So, is Robo a good investment? It depends on your risk tolerance and your long-term outlook. If you believe the world is moving toward automation and AI, and you're looking for a way to invest in that trend without betting on just one or two companies, then Robo is a compelling choice. Its broad exposure to hardware and software providers in the robotics ecosystem gives it an edge over single-theme ETFs. But Robo is not for everyone. Its high fee and lower dividend yield make it less attractive for conservative investors or those seeking stable income. Also, because it is a thematic ETF, it may underperform during times when investors rotate out of growth stocks and into value or defensive sectors. Now let's close this out with my meter rating. For income, I give Robo a 1 out of 10. For growth potential, I give it a 9 out of 10. For volatility and risk, it gets a 6 out of 10. For innovation exposure, a perfect 10 out of 10. And for long-term relevance in a changing economy, I give it an 8 out of 10. That brings the total rating to a strong 8 out of 10 on my meter rating. If you have any videos you'd like me to cover, say it in the comments below, and I will break it down in plain English.